Welcome to The Explainer. Today, we're talking about a piece of financial tech that promises stability in the wild world of crypto, the stablecoin. But what's really holding it all together? Let's dive in.
So, to get a sense of the scale here, just look at this number. In only 4 years, the market for stablecoins has absolutely exploded, growing from about $17 billion to over $170 billion. That's just a staggering rate of adoption.
And we're not just talking about vague institutions either. The number of actual people holding stablecoins has skyrocketed, jumping from under 4 million to nearly 120 million all around the world. This incredible growth is really the core of our explainer today. So what's driving it? Well, to find out, we need to answer two key questions. What exactly is a stablecoin, and why on earth has it grown so explosively? At its heart, a stablecoin is designed to do exactly what its name says, be stable. So unlike Bitcoin or other cryptos that can swing wildly in price, a stablecoin's value is anchored or pegged to a real-world asset, usually a major currency. They're meant to be a calm port in a very stormy digital sea.
Now, to really get the appeal of stablecoins, we have to look at something that seems totally unrelated: the surprising weaknesses of the money we all use every single day. Turns out, the cash in our wallets isn't nearly as foolproof as we think.
See, all modern fiat money, that's just government-issued currency, is built on a single foundation: trust. We have to trust governments not to devalue it, and we have to trust banks to protect it. But history shows us that trust can be, well, pretty fragile, and sometimes it breaks completely.
Just take India in 2016. With a single decree, the government declared that 86% of the country's cash was no longer valid. I mean, can you imagine waking up to find the bills in your wallet are suddenly worthless? It's not a hypothetical. It really happened. Or think about the absolute catastrophe of hyperinflation. In 1920s Germany, the government just printed so much money that prices were doubling every 2 days. Your life savings could literally evaporate in a week. It's exactly this kind of instability that creates a huge demand for an alternative.
So this leads us to a really crucial and, frankly, a pretty ironic question. If this new form of digital cash is trying to fix the flaws of government-backed money, what on earth are they pegging their value to for that promised stability?
And the answer is, well, it's fascinating. This futuristic, decentralized technology relies almost entirely on the most established, most centralized currency on the entire planet, the US dollar. The dollar's global dominance all comes down to a concept called exorbitant privilege. It's this massive, unique advantage the US gets from having the world's main reserve currency.
Okay, so how does it work? Well, because the world needs dollars for all sorts of things, like buying oil, the US can basically buy real goods from other countries with money it just creates. Then those countries take their dollars and use them to buy US government bonds, which is like lending that money right back to the US at super low interest rates.
And the result of that privilege is just crystal clear in the crypto world. I mean, it's not even close. Nearly the entire stablecoin ecosystem, this whole brand new financial frontier, is built on the foundation of the good old US dollar. Okay, so we know they're pegged to the dollar, but how do these digital tokens actually maintain that critical one-to-one link? How does one digital dollar stay worth one real US dollar? It turns out the biggest stablecoins follow two very different paths to get to the same goal. You've got the centralized approach, used by giants like Tether and USDC, and then you have the decentralized approach, which was pioneered by DAI. So the centralized coins, USDT and USDC, they're backed by real-world assets. The idea is, for every digital coin they issue, a company holds $1 worth of actual cash or US bonds in a bank. DAI is completely different. It's run by code, and it's backed by a surplus of other cryptocurrencies that are locked away as collateral. And this difference in structure, it leads to a huge difference in control. Because they're run by actual companies, USDT and USDC can be legally ordered to freeze your funds. DAI, on the other hand, being decentralized, is designed so that no single person or company can freeze or block a transaction. So, all of this brings us to the future. What's going to happen when this rapidly growing technology inevitably collides with the old world of government and financial regulation? Think about this. Stablecoins already make up nearly 1.5% of all global US dollar trading. And that might not sound like a huge number, but for a brand new technology, that is a massive foothold. And it's growing fast. This growth really puts governments at a crossroads. Do they fight this innovation with tough regulations, or do they embrace it as a new way to project the dollar's power across the globe? In a really strange twist, stablecoins could actually end up reinforcing America's exorbitant privilege.
But, and this is a big but, we can't forget that these systems are new and have shown some really serious vulnerabilities. We all saw the total collapse of Terra USD, that scary moment USDC lost its peg during a banking crisis, and of course, the ongoing controversy over what Tether actually has in its reserves. These are not risk-free, not by a long shot.
Which leaves us with a final, critical question. Is this technology making the world's most powerful currency even stronger by extending its reach into the digital age? Or is it introducing a fragile new point of failure into the global financial system? The answer to that is going to shape the future of money for all of us.